Welcome to the complete buying and selling secrets. So, I'm going to take you through the journey of the market in its phase and cycle. Right now, this is a post made on Facebook few hours or just a couple of minutes ago, and from the title here, you see fixed clip feeling like selling gold from first entry price at 2031 to profit at 1981.78. And this was posted just now. I posted this on the Facebook account here. And then this is a description. 500 pips of profit move awaits you. Learn more about trading gold on https://debtorite.podia.com/course. You can sell the next correction market of gold to recover all the impulse move. Sell gold during its correction for the next 2 days. Entry price is $2031.79 at a good opening below the exit price line with take profit price set as $1981.79, which will mark 100% retracement level at the start of the 600 pips impulse that happened in only 4 hours, just in one night alone. Take a shot at shorting gold for this correction move to recover 100% of the completed bullish impulse, which started from $1981.70 to get to a high of $2038, making over 600 pips bullish rally in only one day from a low at 1973. Such a fantastic move that came to its zenith overnight in only 4 hours towards the end of the day. Okay, and now this is the chart. So on the chart here, as posted on Facebook, you can see a down arrow pointing from the given entry price at 2031 to the exit price at 1981.79. So how did this come about? Let's go right into the charts to see. Okay, so this is the chart and this is live. Now, this market started all the way from the price at 1974 after giving an entry formation. Now, from the entry rule that is given, here is the right place to come into the market for the first time. Now, how is it the right place? This is the rule. First, there was a bearish impulse, and now an entry structure was given. Here is the terminal of the bearish impulse at 1977.52, and the exit price line is at 1978.23, and the rule for entry is enter above. If it was a bearish impulse, enter above the exit price line and then hold until an impulse breaks. Then again, if it was a bullish impulse, enter below the exit price line and hold again until an impulse breaks, unless you are trading the end of a trend impulse, which has a minimum of 200 pips to be qualified to be the end of a trend impulse. So while all of these are short impulses, you can always exit after the impulse break. So you took your entry from the third candle rule, which applied here, where there was an impulse that broke, and after the break, you see a structure for another impulse forming. So you enter on the third candle rule. So in that case, the third candle or the entry candle following the observation on which the rule was derived is expected to go opposite the entry bias, and that is why this bearish candle here went against the entry bias, because the entry bias is to be bullish. So now if your third candle goes bearish when you are expected to be bullish, then you have the entry on the fourth candle rule applied. So in this case, you would have had two entries, one on the third candle and the other on the fourth candle. And of course, the market went just as expected because there was an impulse that was broken. And again, now there is an impulse that was broken, and the market gives you another entry plan, which in this case is a bearish entry structure. So if you sold here, what happens to you? You have a sell entry here, and the candle went upward, close bullish. So you also have the fourth entry rule or entry candle rule applied. So you sold again here, and the both market finally drops down. Now the amount of profit made here doesn't meet any minimum amount set, which is 90 pips, or a termination of an impulse. So there was no new impulse formed here, and also no, it didn't go down by 90 pips. So the market went to this previous exit price line and then turned. And this is exit price line was created by the last bearish impulse. So if the market did not break the last bearish impulse, uh, exit price line, and also did not break the level set at the close of that impulse, it indicates that the market is unwilling and unable to go further downward. Now, when this happens, according to your technical rule, you come out of the market in profit, because there was no sustained impulse to go down, because the candle did not close. This was a candle that came to retest, and then after retest it rejected that. So you close in profit, or whatever you have to do that before this market returns back to loss. So now you were out of the market for a sell entry here, and this market did not give you a new structure for either a buy or a sell, and then this pump happens. So what do you do when something like this happens? Now, this is what our rule says. Because there was an entry structure given here, this is a bullish level. This is an entry, or yes, this is an entry price. And we always say that the market rejects the entry price. The market rejects the entry price. Now, it's also the same thing that you noticed here when the entry candle became a bearish candle. You can see the next three candles after that opening or entry price was broken, the next bullish candle came, retested, and rejected the entry price. So the market always rejects the entry price. There are so many things you pay attention to, details that you can easily forget when trading, and that is levels where the market must react to. One of the levels will be the closing price of the break, and that closing price of the break is what we refer to as the turning point of the market, or also the exit price line. Then another place the market rejects to is the low, of the break or the high of the break. So if the break is the bullish break, then the low of the break. If the break is a bearish break, then the high of the break. So in this case, it was a bullish break, and this was a level here. So the market always reacts to that. Then the next place is the entry price. So the entry price is also another important place that the market reacts to. And if the market hasn't gone below the entry price, then the entry is currently put on hold. So because this entry was taken based on the third and fourth candle principle, it was a valid entry that has already activated this entry price. Okay, that means that the market has to recognize this as an entry price and react to it. And that was what happened. Look at it for the first time here. After the entry candle went bullish, following the entry expectation that entry candles always go in the opposite of the entry bias. And that was what happened there. This was supposed to be a bearish move, but it made first a bullish move at the entry candle. And we also explained in our earlier OTC guide that how to know where you have an entry on your chart is to look at a string structure that gets broken, because there is your third candle principle applied, and the third candle is always that one that breaks a string, whether bearish string as here or bullish string as here. So this was a bullish string broken by a bearish break, and this was a bearish string broken by a bullish break. So that is how to identify your entry points in the chart. Now, if you can identify the entry points in the chart, then you always have the entry rules that apply. Now, for this structure of the market, there is a second rule that applies, which is entering in the bias of a break. Now, the reason for that rule is because of what I was about to explain, that the market always rejects the entry price. Now, in one of the places I had asked if it is safe to just take an entry as soon as you find this entry structure following the entry rule, or you should first of all trade in the converse of that entry pattern formed. Now, what is the entry pattern formed here? Based on the break of a string entry rule, based on the break of a string entry rule. Now, what does that mean? First of all, this is a string, bearish string, and this is a bullish break. One of the entry rules states that you should enter at the opening price of the break in the bias of the break. So this is the opening price of the break. Then the rule further states that you can set your limit orders below the break by 20 pips. Now, this is the more consistent rule, and it always applies from the 7 a.m. candle, forward. So the first of this structure you meet in the market will give you the trend projection of the day. And that is also what explains the first and the last principle, that the first shall be the last. Okay, so now this is where it applies. Why this structure here for an entry, of course, gave you a bullish move that did not go against your entry plan, because you will not be entering on the break of a string entry rule here, because this is not come before 7 a.m. candle. So instead, you'll be following the third and fourth entry candle rule here. But in this case, this came after 7. This structure here came after 7, and that is where this rule applies, which is the break of a string rule. And the break of a string rule says you should take your entry in the bias of the break. So since we have a bullish break here and a bearish string that was broken, you are going to mark what you will need to pay attention to here. And the first place to mark is the entry price. Then when you mark the entry price, we always say that for this rule that applies, you have 90 pips deviation as the watch limit to show that that market is not going to go according to this rule here. So from 1981.32, if the market deviates to 1972.32, then you know that this structure here has been cancelled out. So let's look at it. Did the market deviate to 90 pips all the way down to 1972? So that was no. And this is based on trend entry projection. So the market did not deviate by 90 pips, which means that this structure is valid. If you bought here, following that, this, however, being a break of an ongoing impulse, came after the 7 a.m. candle, which gives you not the third or fourth candle entry rule this time, but rather the string break entry rule. Based on this gave you the string break entry rule, then you have to trade string break. And in this case, there was a string that was broken and the break was bullish, and the rule says you take a trade in the bias of the break. So which means that your entry will be bullish. Then you set your limit orders. So first entry price, we also have in the rule saying that if the break is not up to 40 pips, then first you enter on the opening price of the candle that follows the break first, so that you don't miss the opportunity, just in case the trend move will begin immediately without going to retest the opening price of the break, which becomes the entry price ordinarily. So let's measure the break and see 1981.12 to 1984. 1984.18. So you notice that is only 30 pips, so not up to 40 pips. So which means that your first entry came at the opening price, at the opening rather, at the opening of the next candle, which was first entry 1984. Second entry will now be set at the opening price because there must be 20 pips interval, but at the opening price because this is more than 20 pips. So opening price, which is second entry, and then third entry will now be 20 pips below the entry price. So that will be 1979.12. 1979.12. So you had your third entry there, and you still have other pending orders coming below 1977 and 1975. So those would have been the entry structure for this market. So you have, in this case, 3 entries that activated based on this structure. Now, if you have taken this ordinarily, your take profit price is set at 90 pips ordinarily, because you do not know how the market will move ordinarily. But the overriding rule for exit is not 90 pips rather, but the next forming impulse that breaks. And in this case, the next forming impulse was nothing other than a power move influenced by the news of federal rate cut. And let's look at it. This move happened overnight, starting from uh, 9 p.m. and going all the way 4 hours into that. The move went over 500 pips. And by the next hour, which was the sixth hour, or the fifth hour rather, the move went up to 600 pips move. So looking at that alone, your trade could have been held all the way up here if you are following the exact exit rule. Since there is an entry rule, there's also an exit rule. It says exit on the break of an ongoing impulse. So you ride the entire wave of the impulse, and that is exactly what has happened here. So this phase of the market traded is called the trend impulse. This is called trend impulse. And why is it trend impulse in this case? Because first, the market has obliterated the previous structure of the market the moment it breaks the previous high and the previous low. It obliterates that structure. So how is the previous high set? The previous high is set when a bullish break occurs, that's a high, and the low is set when a bearish break occurs. So at the high of the candle that breaks the bullish impulse, you have a bullish break. In that case, bullish break not referring to the candle rather, but the break of a bullish impulse. So you have a high level, which is for a buy. Then you have a sell level, which is when a bearish impulse is broken. So at the low of the break of that bearish impulse, you have the low. So this is low and this is high. Now, in ordinary observation, even without knowing the entry rule that comes after 7 a.m., trading the break of a string, we have string and impulse to observe. So any uh, relationship of same candles that exceed three candle pattern is called an impulse, and any relationship of candles that stop at two candle pattern of same bias is called a string. So we have all the levels drawn at high and low, and the nearest two indicate the direction of the market. So we always say the first shall be the last. So whichever breaks first, if it's the high that breaks first, then that will be the last direction of the market. If it's the low that breaks first, that will be the next direction of the market. So what happened in this case? We have the bearish and we have the bullish. So in this previous case, the low broke first. Okay, so which means that this was the first direction of break, but there was no continuation because immediately this low broke, what happened next? The market returned back into the structure that was broken. So then in the second case, this was a high, it broke the first time, the market returned back, and now we have equal. So this and this are equal, but the next break is occurring on the high, so which shows that the market's pressure is to the upside. So for you, there is early and there is late entry. So where is the late entry? Late entry is when you wait for the break to occur. That's when you wait for the break of either the high or the low. So if we are waiting for this entry here, the rule that follows is formation of a bullish impulse. In that case, if it's the high that breaks, or formation of a bearish impulse. So the third candle principle would apply after any level is broken. And imagine that you were going to do that. So this would have been first candle, you wait, you missed. Second candle, you wait, you missed. And third candle is where you'll be entering at if you are following that rule. Okay, and that is why it is called late. But the earliest place to enter is when you follow the structure of a string that breaks. So you enter before the level breaks. So break of a string, the opening price of the break itself, or the candle that broke the string, is your ideal entry price, and that is your early entry. So that is why this is the ultimate millionaire trading rule, because it is when you follow this rule that you make the most profit from the market. While others are waiting for breakout, you are already in the market. So that even when something like this happens, you are already early to pick all the amounts that you are there. So how many pips profit earlier would you have gathered? 1981 all the way to 2023. That's over how many pips? 40 pips, over 40 pips. 400 pips, sorry, 400 pips move you would have been earlier. So this is the advantage of following this entry rule here. And if you can do this and spot this every time, you'll be in the position to make profit. But now let's say you were already sleeping when this happened because you had a busy day, you missed the whole of this move. So what next do you do? So we have the rule that says that whenever there is an impulse that exceeds 200 pips, then you can expect a distribution cycle before a correction phase will start in the market. And the correction phase is a move to recover all of the impulse move. So, which means that if you miss this move overnight, then you have another action or course of action to take. And that is why you do not give up. So another course of action would be to do what this entry projection line has done here. That is to sell. And where do you sell? In this case, because this was a bullish impulse, you are going to sell below first level. Of course, this is the ideal first level, which might have some risk to consider. I will also explain the risk to consider. First of all, this is the first level so that you don't miss the move. First level is to enter below the closing or the exit price line of the candle that terminates that impulse. So this is the candle that terminates the impulse, and that's the closing price of the candle that terminates the impulse. So the exit price line is kept at the closing price of the impulse termination candle, which is also called impulse break. So in this case, this was a bearish break of a bullish impulse, and you have this as your exit price line. Now, setting the exit price line, you want to take your entry when that exit price line is broken, because your stop loss will now have to be 10 pips above the level formed by that break. So now this was the level formed at 2038. Your stop loss would be at 2048. That was 10 pips, 2048. So would that be? Okay, no, that's 100 pips. Rather, that would be 2039. Your 10 pips will be 2039, because this is gold you are trading, 2039. So it's not that far from there. 2039, this was 2038.6, so 2039.67. That will be your stop loss. Okay, now if that is applied correctly, 10 pips, what happens next is now we have the ordinary 10 pips SL rule, and we also have the 90 pips SL rule. So ordinary 10 pips SL rule applies in situations like this. It doesn't also mean you cannot use the opportunity, since you know that there is going to be a recovery of this market. Doesn't mean you cannot use the opportunity to apply the 90 pips SL rule, because the market, in order to deviate from any direction, must go above 80 pips. So why you set your stop loss at 90 pips is because the market turns from the 80 pips, if that is not the intended direction for the market. So just to be safe, you can have your entry set at the 90 pips mark, which is your last point for your SL. And it is also going to come in following these 10 pips rule. So instead of 10 pips, you do 90 pips, and that will be so 2038 to 2047. That will be your stop loss, which is well in a secure zone. So now, which means that everywhere inside of this level and the easy price line, which also serves as a turning point, inside of this will be your distribution phase, where you can now take multiple entries, all to be held for this to happen with the same stop loss. So what that means is that since the easy price line in this case is your entry watcher, you are going to have your first entry on the easy price line or below the easy price line. Then you do 20 pips again, spread between your next entries, which will all be pending entry or pending order, as the case may be, up to the 90 pips deviation from the level set here. So if you miss the impulse, you must not miss the correction. Now, these are phases you trade in the market. Either you trade the impulse if you meet it. If you could not catch the impulse, then you should catch the correction, because the correction must happen. It's a rule and is a law that is always obeyed in the market. This meets the condition or criterion for correction to happen, because this impulse move that happened triggered by news went past the 200 pips qualification uh, benchmark for you to call it a trend impulse. So this was a full trend impulse. It happened in one day, in only 4 hours. And that shows the power of trading with rules that guide you. So if you had followed the entry rule here, you would have also follow the exit rule here, which will give you the profit for all this. Now, why others who do not know the exit rule will be exiting 10 pips, 20 pips, 10 pips, and still looking for entries all the way out to be mid-level entries. You, for knowing the entry rule, waiting for an impulse to be broken, you would have had all this profit into the exit price line here, which is 2032.28. So that is the beautiful thing about the rule. And that is why this is called a complete buying and selling secret, because in this case, you see you bought here and you understand why, if you are given the entry to have bought here, this explanation covers for that. And then you are going to sell here. Now, why are you going to sell here? Because you know that this is going to be a correction, and this correction must recover 100% the move of the impulse that exceeded 200 pips. So, for that being said, you can now start placing your entries to sell. And that is why that was posted on Facebook, to show you where to take your entry. So this has been a good demonstration of the entry rules. It has also been documented so that you have your time to refresh your mind and look through to remember everything that has been taught in the complete buying and selling secrets course. Thank you. I remain your instructor, Francis Bestman.